Hey, what's up, everybody? It's Tuesday, October 18th. Big day, big day. Yesterday was a big day too, big day. I'm kind of confused because, first let me tell you, I roasted up some coffee today, some Ethiopian Yirgacheffe. I believe that's how you pronounce it. And I sent a pack over to my accountant. He likes coffee. I said, you got to try my coffee, home roasted coffee. It's fantastic if you like coffee. So I sent him a 12-ounce bag of freshly roasted beans. I'm sure he's gonna love it. Anyway, I'm a little bit confused, and I'll tell you why. Here's why. We did have a pretty decent tax drain yesterday of 30 billion. That's what I was expecting, because yesterday, the 17th, taxes were due if you hadn't paid them in April, and that includes yours truly. I had to pay yesterday. Ouch, that hurts. And it was a 30 billion. I said this is not going to be like a big drain like we saw in the September quarterly corporate tax drain, and it's certainly not like the April 15th killer. Certainly not like that. But still, 30 billion, we were getting really close to recovering all that 155 billion drain from September. Remember, that was a big one. It was way bigger than what I anticipated, because I said going into that thing, and I said this all the way back in June. I said, come September, we're going to have a drain. It's going to add to volatility. It'll pressure the market. But I figured we'd get like 110. We got 100, almost 160. So we were this close to recovering all that drain. It was down to just a little 9.9 billion. And with yesterday's drain, we're back to 40 billion. So we're missing that chunk. We're missing that 40 billion. That's going to be recovered without question, because that's it for the tax drains until December 15th. There's another corporate quarterly tax drain, but so we have positive net flows for the rest of this month, which is like 2 weeks, a little less than 2 weeks. And we have November, which is going to be a quarterly interest payment. That's like a 45 billion injection on top of the normal monthly spending of around 500 billion or whatever, 550 billion. So, but still, I gotta be honest, I was a little bit surprised by yesterday's rally with the drain, and even today, right? Because we were up like big in the morning, and some of it was given back, but we still closed pretty strong. And sometimes there could be a 1 or 2 day lag, and maybe to the selling at the highs today, we might pull back a little bit tomorrow. But a couple of things coming together, and which I'm not going to mention right now, but that could be, they could be adding up to a more positive scenario in the immediate sense and in the longer sense. And obviously I just gave you the longer sense until mid-December. I mean, we passed all these terrible drains, and now it's pretty much like positive. We'll see pretty much like positive flows. We should. I mean, I said that in September, and then we kept going on for like another week, 10 days of drain. But yeah, today's rally and yesterday's rally kind of surprised me. So that's that point that I wanted to make. The other point, or points that I wanted to make, when we started to have the lead up to the Fed rate hikes, when all the discussion and the hysteria started to build up, and the Fed was signaling to the markets and to investors that we're going to start to raise rates. We heard a lot of this, that's going to kill the economy. It's going to, you're going to have bank lending is going to collapse. Nobody's going to take any loans. right? I mean, we heard all this stuff. There's going to be, production is going to go down, the economic output is going to go down, et cetera, et cetera. And the reality is, none of that has happened. I got a couple of charts here that I want you to look at. First of all, and I saw somebody mention this on Twitter earlier today when they said rate hikes mean lower production of goods and services. Like just stated, as a matter of fact, axiomatic. Rate hikes mean lower production of goods and services. So I was like, I don't know. Let me take a look. So I went to take a look. And sure enough, since the rate hikes, we've actually seen an acceleration in business inventories. Inventories have climbed up to a record. Okay, you see that here. Inventories, that's goods and services, things on the shelves of businesses have climbed up to a record. If anything, that dip prior to this recent rebound was the pandemic and the supply chain issues, and that is completely understandable. I mean, again, to me, and to I think people who are really being thoughtful about this, and I don't mean thoughtful as in considerate, I mean thoughtful like, they're thinking about it. The pandemic and the disruptions in the supply chain, which by the way, that's still a feature of the global economy, especially with the sanctions on Russia and all this other stuff with energy and food, absolutely continues to be a feature of the global economy. However, when the pandemic hit and everything was shut down and the supply chain was really, really shut down, I mean, yeah, you were going to have inflation from that because you didn't have a sufficient amount of supply to meet demand. I mean, that's economics 101. That's very, very simple. But as the supply chain issues start to abate, as they started to ease a little bit, yeah, what's happening? We're getting this big rebound in business inventories, and that's just going to end up being a moderator or a moderating factor in prices. I mean, the Fed was right, Powell was right, and Yellen was right when they said it's transitory, but like nobody has any patience, and I understand that's a political thing, right? Because now the Democrats and Biden are under a lot of pressure, and they might get really, given a landslide crushing in the midterms, because that's the number one concern of voters right now. If you look at the polls, it's all about inflation and the economy. But Biden said to Powell, go ahead and jack up the rates. That's just, I don't know if it's making it worse. It's making it worse in the sense that, yeah, when you raise rates, what's happening? You're raising the general price level. So, inflation would probably be lower. I mean, the last reading we had on CPI, and who was it? Yellen, I think she said, not Yellen, it was one of the FOMC people. I forget who it was. But it was a woman. I remember that. Maybe the San Francisco Fed president, what's her name, Daly or something like that. She said the numbers are not cooperating. That was like literally her words. The numbers are not cooperating. Like, come on numbers. We keep jacking up the rates, and what's happening? The CPI is not coming down very much. Well, yeah, because the cost of credit is reflected in the cost of all goods and services. You raise the interest rate, you raise the general price level. I mean, how many times do we have to say that? And you don't have to listen to me. I just keep giving these examples. Like, has higher interest rates helped to squash inflation in Turkey? Have higher interest rates helped to squash inflation in Argentina, which, by the way, the rate now is at 75% and inflation's at 100%? Has it helped to squash inflation in Brazil? I mean, again, folks, I could keep repeating it. I know you know it. You guys know it. And it probably makes you probably close to as crazy and mad as it makes me when, if you have any kind of a scientific brain, if your theories don't show up in the empirical evidence, what do? You go back, you you rethink your theories, you try again, you try a different method. No, it's only these guys who keep doing the same thing. Anyway, so I showed you inventories. How about loans? They all said, oh, loans, nobody's going to borrow. Nobody's going to borrow. Here's loans. Loans are accelerating. They're growing at the fastest rate in 14 years. And I know some of you said to me in comments, well, Mike, people need money now. They got to, they're borrowing to bridge the gap. Yeah, but listen, you can't, as much as I might need money or you might need money, if you go into a bank and you say, Mr. Banker, Ms. Banker, I need money, give me a loan. They're going to say, okay, fine. Let's see your financials. Let's see your income. Let's see your balance sheet. How much debt do you have? They don't just give you money because you need it. You have to be credit worthy, and that means you have to have the ability to pay it back. So if loans are zooming up like this, even with rates going up, it means the credit worthiness of the borrowers, at large, it's fine. So that's another thing to keep in perspective. Industrial production, here's another one. Fed started raising rates. Industrial production going up. I mean, again, the thing that is missing, not from me, but the thing that is missing in all of these hysterical arguments that we hear in the media, when they talk about rates and the destructive and the disruptive and the terrible and the horrible consequences of interest rates, the thing that is missing is that there's two sides to this equation. And the other side is the government is a net payer of interest. It pays. And when the rates go up, that is a massive, and it's just getting started, I'm telling you, an income transfer to the government. All right, I mean, from the government to the economy. It's adding to the financial balances of the economy through that interest channel. I mean, you have to understand, both sides of the equation. If you merely look at it one way, then of course you're going to come away with this hysterical, frightened view of what's happening. But, that's an incorrect way to see it. Or, it's missing a piece. It's missing a piece. All right? I mean, if you're trying to build something, a structure or whatever, and it's missing a crucial piece, whatever that thing is, it's not going to work. It's either not going to stand, it's not going to fly, it's not going to float, whatever. It's missing a piece, a big piece, because there's two pieces. There's not like 100 pieces, and if you miss one, okay, the thing is still going to work. No, there's two pieces. There's that income transfer, which nobody talks about, and then there's that the taxing effect, if you want to call it that, from a higher rate. It's a redistribution. The water stays in the pool. The only thing we got to be concerned about is what is adding water to the pool or what is taking away water from the pool. Rates rates do have an impact on that. They add water to the pool because of that government being a net payer. So even in that case, the rate hikes are adding water to the pool. That's if you want to think in a macro sense, folks, here's what you do. You just envision a swimming pool. You got a big pump, which is the government, okay? In our case, in the United States, in Japan or China, it would be different because they're net exporters, so we are their pump as well. But here, you just consider this. You got a big swimming pool, you got a pump, but the pump could flow two ways. It could push water into the pool, okay? Or it could suck water out of the pool. And sucking water out of the pool is taxation. Or it could be like negative interest rates set by the Fed like they do in Japan or in Europe. Not anymore, but ECB had them negative. That's sucking it out. So that's all you have to think about. it's going swimming. It's summer all year long. Just think about that swimming pool. Are you putting water in or are you taking water out? And as long as you're putting water in, even if it's a slow drip, as long as more going in than coming out, right, there's always going to be leakages. I mean, taxes go on all year long, as we've seen every quarter, right? But as long as more is going in than coming out, it's like the tide coming in, everything's going to be lifted up, all right? Just simplify the whole thing in your head, and you're going to be fine. You're going to be better than any flashy, big shot Wall Street guy out there. And you need to know the macro picture. I've had people who are subscribers that say, oh, Mike, I don't need your service anymore because, I just, you don't tell me what stocks. Well, I do from time to time. I've been talking about banks, everything, oil stuff, energy. But I mean, look, it makes no difference to tell you a stock if the basic conditions of the economy are not conducive, right? If they're sucking the water out of the pool, I could give you the next Amazon, I could give you the next Apple. It's not going to make any difference, folks. And by the same token, I could give you a dog stock, and if we're doing like a pandemic stimulus, everything's going to go up. So I mean, really, really try to frame everything in that big picture. Just remember the swimming pool. Remember the swimming pool. That's all you got to know. All right, everybody. Go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. Bye.